in Zoom land. I can't tell if you're there, so it's a little odd for me. I could be talking to one person, I could be talking to 50. I can't tell, but I hope you are enjoying the start of the Housing Washington Conference, and I'm excited to present this Affordable Housing 101 presentation. So because of the situation here, I can't see chat from you, so we're going to take questions at the end, and Lynn, our helpful facilitator, is going to transfer questions to me at the end of the session. So I'll try to leave a little bit of time at the end for those questions. So don't leave me hanging. Give me a few questions along the way. I'd rather do this in an interactive way, and I'd rather see you all in person, but we're going to do what we can in this Zoom world. So Affordable Housing 101, let me start by giving you a quick outline of what we're going to do. We're going to talk about what the definition of affordable housing is, who does it serve. We're going to touch on the process of developing affordable housing. We will talk about how it's funded and how you make it pencil. In other words, how it works financially. And then if we have time, we'll touch on some of the future trends that are at play. There's a lot of material here, way too much for 50 minutes. So I am going to speed through some of it and focus on a few things that I think are the most important for this conversation. The slide deck, I believe, will be available through Housing Washington, and if not, you can certainly reach me, and I'm happy to send you the slide deck and answer any questions offline as well. So let me tell you about Beacon Development Group. So I've been with Beacon Development Group for quite a while now. Must be a good fit because I keep working here. And we do affordable housing development for clients and on a consulting basis throughout Washington. And we also have a parent company that does affordable senior housing, and we do their development in Washington, California, and Pennsylvania. So this slide here, you can see our experience covers all types of projects, family, senior, farm worker, special needs, urban, rural, etc. We've done about 100 projects in our, 25-year history now. In terms of what is affordable housing, oftentimes people have a misconception about what affordable housing is and what it looks like. The affordable housing that we're talking about in this conference and in this session is high quality, well-built, well-designed affordable housing that serves as an asset both for its residents and its neighborhoods. So I want to show you a few pictures of what that looks like. This is an affordable housing project for farm workers in the city of Pasco. This is an affordable housing project for seniors in Bremerton. This is Plaza Roberto Maestas. This is where I'm sitting actually right now. This is where our office is. We did this in partnership with El Centro de la Raza, right next to the Beacon Hill light rail station. For any of you who have been up here to Tacos Chuki's or the Beacon Hill light rail, you know where we're talking about. This is a historic high school that we renovated for the Spokane Housing Authority. This is 40 units of senior affordable housing with the Pike Place Market in downtown. This is a project we did with Housing Hope in Everett. This is 65 units of housing for very low income and homeless, formerly homeless households. And it has the distinction of being a new markets tax credit deal with ground floor retail and job training space. It's also a net zero project, meaning that the residential component produces as much energy as it uses over the course of a year. So super cool project. And then lastly, just to show you the diversity of work that we're doing right now, this is a shelter and multi-purpose service center for homeless youth in Everett that we did with Cocoon House. So that's a little bit about what affordable housing can look like. Let's talk about the definition of affordable housing. So housing that's affordable to its occupants means that the residents are paying no more than 30% of their income for housing costs. Housing costs, when you're talking about rental housing, includes the rent and utilities. Ownership cost is a different calculation, and ownership costs is considered affordable at above 30% because you are building equity in an asset. Now, for this presentation, I'm going to be talking just about rental housing because that's what we do. We just do rental housing. I would not be able to convey much expert information about ownership housing. But there is and I believe there are some sessions today and tomorrow about affordable home ownership that you should check out if you're interested. So housing types included in the definition of affordable is quite a broad range. It can include anything from night-to-night shelter to special needs, specific populations like vets or those with disabilities or farm workers, working poor folk. Poor is in quotes there because that's not my favorite word, but folks who are working but earning wages that qualify them for extremely low and very low income housing, and then a vague definition called workforce housing, which can mean a lot of different things to a lot of different people. But in general is sort of that 60 to 100% of area median income, or even up to 120% of area median income in certain high cost areas. And then, as I said before, ownership housing can also be included if it's serving lower income households. So you heard me use the phrase area median income. This is an essential phrase in affordable housing. It's how we measure who is being served. So you'll hear this thrown around a lot. An area median income is a census-based data point that is produced for every county in the country. So every county has its own area median income based on the income levels of the county's population, median being the point at which there is half of the population above that point and half below. So, let's say the median income in your county is $100,000 for a family of 4. So 0 to 30% would mean that folks earning up to $30,000 a year are considered extremely low income. Those earning up to 50% of area median income are considered very low income. 50 to 80 is low income, and 80 to 120 is moderate income. You'll see the note there that says 60% maximum for tax credits. So you'll see later, you'll hear me talk later about tax credits, and the maximum eligible income limit for the tax credit program is 60. So most of the housing that is produced with tax credits, and therefore most is at or below 60% of area median income. So here's an income chart showing you a few different counties and the 3 main AMI levels, 30, 50, and 60. So you can see that 30% AMI in Yakima County is $19,080 for 2021, and that's for a 3-person household. The numbers are different for each household size. So 1-person household being lower and 4 or 5-person households being higher income limits. So you can see Yakima is a lower income county than Spokane and King. And you can see how the difference between 30, 50, and 60% lays out. Now, To convert that to rents is a very simple calculation. You simply take the annual income limit, divide it by 12, and multiply that by 30% to get the maximum affordable rent for that household size. So a three-person household would generally be living in a 2-bedroom unit. So these are the rent limits for a 2-bedroom unit for the Washington State Housing Finance Commission, which publishes this data, both the income limits and the rent limits for every county in Washington State. So if you want to check that out, go to the Washington State Housing Finance Commission website, and you can find the full rent charts. So what this means is that a household that's earning up to 30% of area median income would pay $477 or less in order to be considered living in an affordable apartment. So when we do affordable housing projects serving these different income levels, these rent limits apply. And so you wouldn't be able to, in order to comply with your funding guidelines, your compliance guidelines, you wouldn't be able to charge more than these rent levels for these different household sizes. Okay, this is a point where I would ask for questions. So if you have any, note them down and we'll pick those up at the end. All right, so on to who provides affordable housing and what's the process. So a lot of different providers, primarily, though, I would put them in these 4 buckets: housing authorities, nonprofit organizations and social service organizations, public agencies, and private market providers. Now the process. So the process looks very much like conventional real estate, but there are a few important differences. So the first step in the development process would be defining your project and determining if it's feasible. So looking into the crystal ball there. So deciding, think of yourself as a developer and you want to do a project. Well, you're going to decide who you're going to serve and where you're going to do it. What's the market? What's the need in that market? And what makes you the right provider to meet that need? You'll see as we go through that a common theme here is funding is very constrained. So the process to get funding from local, state, and federal sources is extremely competitive. So you need to make a case as to why you're the right provider to serve this particular need in this particular location. So once you've decided population, location, then you would do the standard due diligence for a real estate development process, figuring out what are the conditions of the site. Are there environmental conditions? Are there title conditions? Surveying the property to see if there are easements, utilities, or other issues, doing initial design studies. And then you start to build your initial pro forma. What are the costs and what are the likely sources that you can bring to the project? All right, so then once you have what you consider a feasible project that you think has legs to move forward, then you put it all into an application process to the various funders to assemble the necessary sources so that you can pay those costs. Generally, the applications are going to go to multiple public sources depending on your project and the population. The lower the income you're serving, the more sources you probably have to assemble to make it work. So funding sources could include city, county, state, the the local finance agency. In our state, it's the Washington State Housing Finance Commission. And generally you start local and then go to the state level and to the tax credits last. All right, so let's say you got through that funding process and you're ready to move forward with full design and permitting process. Now, this is a difference between market rate or conventional real estate development and affordable development. Generally, conventional real estate folks, they have the capital to move ahead with design and permits. Once they decide a project is feasible, they can proceed without delay. Affordable housing, we have to assemble the funding, which takes time. It can take 3, 6, 9, 12 months. And so we generally have to push pause in order to assemble that funding before we fully engage the architect for design and permitting process. In some jurisdictions like Seattle, that's not possible because permitting takes so long. You actually are forced to start full design during the funding process, which is extremely risky. But in some cases, permitting doesn't take that long, and so you can wait to determine if you have the funding before you launch into the full design and permit process. So in the design process, there are a number of considerations. You not only want a functional and long-lasting building at extremely efficient cost, you also have to meet a number of additional requirements like sustainability requirements, specific program requirements for the population you're serving. You may have lender or investor preferences that you need to incorporate into the design as well. And of course, managing the permitting process can be extremely challenging depending on where you are working. All right, so then let's say you get through that design and permitting process and you get the joy of experiencing an affordable housing closing. I think of it as a hockey fight. It's always difficult. It's extremely complicated, lots of opinions. Nobody usually gets hurt though, so that's good. So the closing process, all those different funding sources that you had to assemble, let's say you might have a city and a county and a state loan and a tax credit investor and a construction lender, all of those different funders are going to have a different set of attorneys and a different perspective on some issues. And so working all those out in the documents is extremely difficult. So get a good lawyer on your side. A key part of the process is the guarantees, managing guarantees, that last bullet there, number 4, because as the sponsor, you are going to have to promise all those funders that you are going to deliver the project on time and on budget. And especially in the construction lender and the investor are going to have monetary penalties if you are not able to do that. So those guarantees can be onerous and extremely risky. And it's definitely a barrier. It's a barrier that people are working hard to get around because it's a barrier to new organizations and less capitalized organizations to enter this industry. So figuring out ways to partner or to have public entities support smaller or new organizations in this field is a current challenge as we are trying to usher in more community-based organizations, BIPOC organizations, and some of those organizations have been marginalized over time and therefore don't have the access to capital that other organizations in the industry do. So one of many points in the process that can be a challenge to community-based organizations. In terms of the funding sources, I just want to show you what documentation is involved in a single funder. So the State Housing Trust Fund, let's say they're a part of your project along with the city and the county and the construction lender and the investor. Well, just the State Housing Trust Fund has these 7 different documents that would be at play. What you said in the application, your promissory note, your deed of trust, your loan agreement, reg agreement, subordination agreement. If we had more time, I would walk through what some of those mean, but the point here is that each of these different funders has a list of documents that have to be dovetailed together in order to make the closing work. All right, and then on to the reason that we all do this, construction, actually producing the product, either constructing new building or renovating an existing building. So in terms of construction, it's where the rubber hits the road, if you will, because probably about 65 to 75% of your total project budget is tied up in the construction line item. So it's where all the risk is. It's where the project can either succeed or fail. So you want to find a contractor that you really trust, hopefully one that's hungry and willing to do the work at a reasonable price. That's sort of funny because I don't know that those contractors are the hungry contractors exist anymore. They get to sort of run the show right now because labor shortage, contractor shortage, and the process that we put them through in the affordable housing world is so complicated that very few are willing to venture into the process. But we have some really good contractors around the state who understand the process and deliver great product. And then, of course, the contractor will also have to comply with sustainability requirements, prevailing wage requirements, things like Section 3 and WIMBY hiring goals. And on top of that, we have to meet timeline requirements set by your tax credit investors so that the project is complete on time and the tax credits are delivered on time. Lastly, lease up and management. So once the project is complete, your third-party contract property manager or your in-house property manager steps in and quickly and easily leases up the building and manages to comply with all the various different regulations. I feel like it is a extremely complicated process, thus the graphic that you see there in front of us. Lease up issues, you need to deliver on time to meet the tax credit investors' financial requirements. And you also want to make sure you lease up to fully qualified households. So those households have to meet the income limits. If they're over income, they are not qualified and you would not meet your compliance requirements. And of course, you have to deal with all the regular leasing objectives of getting long-term residents who can live in a community together and make it a home. And then, of course, once you have leased up, then long-term management starts, and that will be the next class, Affordable Housing Management 101, and I will not be teaching that one. I can tell you that. God bless the property managers. All right, how is it funded? So, as I've said, it's an amalgamation of various sources from local, state, and federal providers. It's also going to involve capital subsidy sources, and in some case, operating subsidies. The type of sources, let's look at city and county funding. Where does the city and county get their money? So there are entitlement cities that get, and counties that get CDBG and home federal pass-through funds. There are some cities and counties that have property tax levies, like the city of Seattle, King County, city of Bellingham, city of Vancouver. There are also state pass-through funds through recording fees that are collected at the state level and transferred to local jurisdictions. State funding. State funding is critical in our affordable housing environment. And here's a look at the last, what is this, maybe 7, 8 different biennium budgets. And the point here is there is a come and go cycle with in terms of capital funding for the Housing Trust Fund at the state level. And way back in 07, 09, we were at 200 million. And only in this last biennium did we reach that level again and surpass it. The last biennium was very good for housing, with multiple capital programs funded, in addition to resources being put into programs and operating subsidies and rental assistance. So kudos to the state legislature this last session. In addition, there are direct appropriations, recording fees, real estate excise tax is an important way to raise funds for affordable housing. 1590, that was a House bill that was passed a couple sessions ago, and it allows local jurisdictions to retain, not retain, but add 0.1% sales tax that they can collect for housing. So a number of jurisdictions are implementing new programs to spend that funding. And of course, the bottom bullet there, ARPA, American Rescue Plan Act of 2021, in response to the COVID pandemic and the economic impact that had brought numerous resources to the state, and then the state passed some of those through to jurisdictions. And then the federal level, there's housing and urban development programs, 202-811. Those are programs that used to be well-funded, have been unfunded for a while, but are starting to make a comeback. Money for public housing authorities. Section 8 vouchers is the biggest HUD budget program. So Section 8 is a rental assistance program where the lucky folks who are able to obtain those vouchers, and I say lucky because it's every housing authority that distributes these pretty much has a long wait list. There are more folks in need of vouchers than there are vouchers available. But what that voucher does is it allows a voucher holder to rent an apartment in the market and pay 30% of their income toward the rent, with the federal voucher providing the landlord the balance of the rent. So as rents go up over time, the cost of the voucher program goes up over time. There's also a National Housing Trust Fund. It's growing. Washington State got $16 million in National Housing Trust Fund dollars in 2021. And then there are USDA rural development programs as well. Okay, this is more fun when we do this in person, because I ask the question, which federal agency runs the nation's largest housing production program? And then I would ask for answers. People would say HUD, or they would say Department of Defense, or sometimes the USDA. But actually, it's a surprise to most, and it's a surprise to me still, that the largest production program is run by the Internal Revenue Service. So that is where the low-income housing tax credit program lives. Because it's a tax program, it's monitored by the IRS as a part of the Treasury Department. The program was put in place in 1986, signed into law by the Gipper himself, Ronald Reagan. And oddly enough, it was sort of similar to the new markets tax, the opportunity zone tax credit, where Republican president put in place a tax reform that really benefited mostly wealthy folks. And the low-income housing tax credit was sort of a bargaining chip, a crumb, if you will, thrown to low-income and progressives. And oddly enough, it's grown and survived for these 30 plus years and become a pretty successful program. It is a federal tax incentive, and it encourages private investment. So the way it does that is the federal government provides a tax credit to private companies, mostly banks. And in exchange for that credit, the private investor provides capital directly to the affordable housing project. So it's sort of a triangle of beneficiaries where everybody's getting something from the other parts of the triangle. So the federal government gets housing, low-income housing production, the affordable housing developer gets capital, and the investor gets tax benefits from the federal government. And since the inception of the program, over 3 million units of housing have been produced. So it is a reduction in the investor's tax liability, and that reduction lasts for 10 years. So they would get an annual reduction, a tax benefit of over a 10-year period. There is a 15-year recapture period, however. So the investor gets benefit stream for 10 years, but they have to make sure the housing remains affordable, or they risk recapture. In other words, the IRS can take benefits back from the investor for a 15-year period. So generally, investors are in it for 15 years, and then they exit the partnership. So there are two types of tax credit. There's a 9% program and a 4% program. The 9% program is very competitive because it's limited. The 4% program is less limited. In some states, it's not limited because it's automatic with bond cap. So if you get bond cap, you get the credit. That's a whole nother session, which we won't have time for. But in some states like Washington and California, the bond cap is oversubscribed. So that means that there are projects who are not able to access the 4% program. All right, we're running low on time, so I'm going to pick it up here and quickly show you an ownership structure. So there would be, let's figure out how this $1 million in tax credit allocation translates to equity. So there would be an LP or an LLC setup made up of a general partner, which would be the sponsor or developer, and the investor. And so that 1 million per year for 10 years is 10 million in tax credits. Then what we would do as a developer is we would put that out on the market, and we would invite tax credit investors to make a bid for that $10 million of benefits. And depending on the market, we might get 95 cents per credit, which right now would be really good. There was a day when we saw over $1 in some markets. 95 right now would be extremely good pricing. And so that means $9.5 million of equity for the project. But in some locations and for some developers or project types, there would be a perception of higher risk and lower return. And so the investor might offer 85 cents, which obviously reduces the equity contribution, thus creating more gap that has to be filled by an investor, by a public funder. Okay, So how does this pencil? Or in other words, why can't this work without all these subsidies? Why can't we just develop affordable housing in the private market with private capital? Well, let me see if I can explain some of that. So on a conventional $20 million real estate deal, you might have about 30% of that deal paid for with owner equity, and the rest, 70% or so, paid with debt of some form or another. I know that's oversimplified, but that's basically the combination. Now, our projects are very different. We don't, let me see this. We don't have owner equity. Our developers aren't sitting on $6 million of equity that they can invest in a project and count on getting back through appreciation and cash flow, because it's affordable housing. There's no appreciation or cap. The 14 million of tax credit equity is the biggest slug of capital that we get in this deal. And then we might fill in the rest with city, county, and state sources. So that's a quick and dirty on why we need the subsidy on the capital side. Let's look at the operating side. So on a conventional deal, you would have your market rents coming in on a monthly basis, paying for operating expenses, paying for any debt payments, and the difference would be your cash flow. Now on an affordable deal, let's talk about a 50 to 60% AMI deal. Your rents are lower, but you still have a rental income stream. You have operating expenses, you have a little bit of debt payment, and a tiny bit of cash flow. Okay, that works without operating subsidies. But when you're serving people at 30% and below or extremely high needs populations, you have much lower rental income stream, much higher operating and supportive service expenses. And so the only way to get to break even is to add in this subsidy. And these operating subsidies could be Section 8, because that Section 8 rental income is higher than a regular tax credit rent. Because remember, Section 8 is based on market rents, not on Section 8 rents. So we all love those Section 8 vouchers. O&M, operating and maintenance programs through city or state or county programs, and then various service dollars to cover service expenses for the specific population being that resides in the project. Okay, so this is a sample pro forma. A 60-unit project, this is assuming a 9% tax credit execution. So multiple line items, the primary ones being, land, construction related, A&E, permits, impact fees, reserves, some developer fee to cover the costs and the risks that the developer is taking to undergo this 3 to 5 year odyssey. And then this column over here is eligible basis. I'm not going to go too deeply into this, but just suffice it to say that the eligible basis is part of the tax credit calculation to tell you, of this 19 million, how much can we get in tax credits? And so this basis figure, these are all the depreciable of these costs, of these total development costs. You take the depreciable costs, and those are the eligible basis costs. That's about as far as I can go in explaining that as a non-accountant. Sorry, but that's what drives this 17 million figure. Then you take that eligible basis figure, you apply various percentages, like is it a 9% deal? Is it in a boost area, 130% boost area? What is the annual per credit limit that the commission applies to your project? Then the combination of those calculations will tell you your annual credit amount, your 10-year credit amount, multiply that by your price, and you get $9.2 million. So in this project, whoops, I skipped ahead. In this particular project, that results in an 11.9 million of equity layered in with your state and local and deferred fee, and you have a balanced pro forma. Yay. Now, there are many things that can drive an imbalanced pro forma. In this case, what I've done is changed the credit amount from a boost area, and a boost area, that 30% comes when you're in a certain census tract that's either a high poverty or a difficult to develop area, and those are defined by HUD. And so instead of 130%, this number is 100%. Well, that drives a $9.2 million equity investment, which creates a shortage of 2.7. So just one way, this price, of course, could be another way that is reduced. How much equity you get per unit can be a difference. And of course, if this is a 4% number instead of a 9% number, again, you have a bigger gap to fill. So this is an operating pro forma, and basically just lays out your rents, how many units you have at the different bedroom size and AMI targets, and the rent levels from your WishFIC rental chart. Take out the utility allowance, and you get your net rents. Then the operating expenses on this side, in this case, leaving a net operating income of $66,000 in year one. Well, that's great, $66,000 of positive cash flow, good deal. But the trick here is we generally inflate rents at 2 or 2.5% per year, and we inflate expenses at 3 or 3.5% per year, which means that obviously over time, the expense inflation is going to overtake the rental inflation. So that's why you see this, that's why you see this net operating income going down, 66, 63, 61. And in a real pro forma, this would be extended out 15 and even 30 years. And 15 years is especially important because what you want to make sure is you can show the investor who's in the deal for 15 years, exits after 15. You want to show the investor that you have positive net operating income for those first 15 years. Okay, Lynn, can you tell me if we have questions in the chat?
Yes, Brian, I have been posting them in the Zoom chat here for you. There's quite a few, so you can start from the top down.
Great. So I'm going to do top for just a couple more minutes, and then I'll take questions for the last 5. So what does the future hold? So obviously COVID has been an incredibly huge impact in our industry, both in terms of need and in terms of funding available. It also, though, I think will have a longer term impact that on our way of thinking. How do we design properties and how do we operate our properties, especially when we're dealing with vulnerable populations? The resource demand is still outpacing the funds. So state and federal resources are increasing, but there is an incredible competition for resources, both within the housing field, but also between needs like infrastructure, education, mental health, etc. The safety net, it continues to fray. People's needs are not being met. The complexity of homelessness is increasing. And now we have a new layer with police response, where in some communities, the needs of folks with high challenges are not being responded to in the same way that they used to be. Urban, suburban, rural, all areas of our state are impacted by housing and homelessness now. Fortunately, the tax credit market remains strong, but the amount of capital in the market is somewhat tenuous. We're trying to get more credits available through reforms, but that a credit doesn't do you any good unless there's an investor to buy it. So hopefully we can continue to grow the market. And of course, rising costs, huge issue, construction and labor costs, and then public awareness. I think housing and homelessness is a growing issue in people's minds, which is essential to solving the problem, and hopefully resources and programs will follow that. Okay, I'm going to skip ahead to the nice picture at the end, and thank you for listening, and hope that you will continue to explore this work and help us in this challenge going forward. So let me see if I can take a few of these questions. So someone's asking about the utility allowance. So let's say that the maximum rent is $477, like it was on my slide. Then let's say the utility allowance, which is based on the county's local utility cost and how much the utility expenses, how much of the utility expenses the resident pays. So in some projects, the resident might pay for electricity only. Some projects, they might pay for electricity and hot water. So it depends. But let's say for this county where the rent is $477, let's say the utility allowance is $50. Okay, so you take $477 minus 50. So that would result in a rent limit to the resident of $427. All right. Make this bigger. Since funding sources are so competitive and constrained, can you talk some about local funding options? So hopefully I touched on those local funding options. The thing that we really need to have in place in all, especially high cost areas, is a local levy that spreads sort of the wealth from property owners to non-housing stable folks. And of course, with exemptions for low-income people, because we don't want tax levies to burden low-income folks. Does funding for affordable housing generally take the form of loans or grants? It can be both. Mostly it's loans, unless you're serving homeless populations and the lowest income populations, then it can be in the form of grants. Grants, though, and tax credits don't go well together. I can tell you more about that if you want to learn at another time. What are the consequences for a LIHTC owner if they are not compliant in the second 15-year phase? Okay, good question. So the regulatory agreements for the LIHTC owner, even though the investor has exited the deal, those LIHTC obligations continue. So they would continue for up to 30, even 50 years, depending on the regulatory agreement. So the owner has to continue to comply with those restrictions. Okay, there are more questions here that I'm going to be able to answer. We only have 1 more minute, so I'm going to just conclude. I'm sorry I couldn't get to all the questions. Do email me, brianl@beacondevgroup.com, if you have more questions. And I really appreciate you coming to the session. And I will conclude it there and hope you have a great rest of your day and enjoy Housing Washington.
Thank you,
everybody.
Bryan.
Thank you, Lynn.